President Obama is proposing a one-third increase in the capital gains tax rate from 15% to 20%. To figure out whether this is a good idea or bad idea, this Center for Freedom and Prosperity video will look at the principles of sound tax policy. I'm Dan Mitchell of the Cato Institute. Thanks for joining the discussion. Let's start with some simple definitions. A capital gain occurs when you buy something and then sell it at some later point for more money. The difference between the purchase price and the sale price is the capital gain, and a capital gains tax, needless to say, occurs when politicians impose a levy on that amount. To figure out the right capital gains tax, let's start by looking at the two main theories of taxation. Folks on the right, generally speaking, believe in what public finance economists refer to as consumption-based taxation. This is a fancy way of saying that the ideal system, from this perspective, should have no double taxation of income that is saved and invested. This is why proponents of consumption-based taxation usually support reforms such as the flat tax or national sales tax. The people on the left, by contrast, largely believe in the Haig-Simons theory, which is the notion that people should be taxed on both their income and any changes in net worth. In simple terms, they want double taxation of saving and investment. Proponents of this approach like the Internal Revenue Code, perhaps not every nook and cranny of the current system, but certainly the main features. Advocates of consumption-based taxation explain that it is important to get rid of the tax bias against saving and investment because all economic theories, even Marxism and socialism, agree that capital formation is a key to long-run growth. Simply stated, we can't enjoy higher living standards in the future unless we're willing to set aside some of today's income to finance tomorrow's growth. Let's explain why this matters using the capital gains tax as our example. Let's say you earn money and pay tax on that money. You then have two choices of how to use the remaining after-tax income. You can consume your after-tax income, or you can defer that consumption by choosing to save and invest. In a neutral tax system, one with no double taxation, the government will not interfere with your decision to consume today or consume in the future. Unfortunately, that's not what we have. Between the capital gains tax, corporate income tax, personal income tax, and death tax, a dollar of income can be subject to 4 different layers of taxation. But the key thing to understand is that these extra taxes only apply if you save and invest. In other words, if you do what's best for society, you are penalized by the IRS. But if you live for today and don't worry about tomorrow, the government leaves you alone. Let's look at the issue from another angle. Let's say you buy some stock in a company. You're presumably hoping the stock increases in value, but did you ever stop to think about what actually causes a stock's value to go up? Ask just about any finance or market expert, and they'll tell you that a stock goes up in value when there is a market expectation that it will generate more future income. Yet, that future income will be hit by both corporate income tax and personal income tax when distributed as dividends. So the capital gains tax can actually be thought of as a preemptive form of double taxation. And people wonder why Americans don't save and invest enough. Now, by the way, the capital gains tax is not indexed for inflation. So if you made an investment 25 years ago and sold it today for a 50% gain, you actually would have lost money because the dollar lost so much of its value. But the IRS wouldn't care. The capital gains tax still applies. This is something to keep in mind with most people expecting higher inflation in the future. Let's close by now considering some of the implications of taxing capital gains. 1. Less investment. This is simple economics. If you make future consumption more expensive relative to current consumption with the tax code, people will respond by saving and investing less. 2. Less risk-taking. Big breakthroughs that make our lives better often are the result of entrepreneurs and investors who take a big chance in hopes of a big payoff. The capital gains tax, though, reduces the payoff, so it obviously reduces the incentive. 3. Less competitiveness. Many other nations don't tax capital gains, including some European welfare states. They understand that investment is very mobile, and they want to attract job-creating capital. 4. Less privacy. A capital gains tax is necessarily intrusive since busybody politicians and tax collectors need to know when you acquired something, how much you paid for it, when you sold it, and how much you sold it for. It should be none of their damn business. 5. Less employment. Jobs don't grow on trees. If someone's not willing to provide capital, workers are the ones who suffer most. 6. Less fairness. I don't believe in punishing success of any kind, but it is especially bizarre to impose extra taxes on people who save and invest. The law should treat people equally, regardless of how they earn their income, how they spend their income, when they spend their income, or the level of their income. So what does all this mean? The correct capital gains tax rate is 0. President Obama should be eliminating the tax, not making it more burdensome. It's bad enough that the government taxes our income one time. Letting the IRS get more than one bite of the apple is wrong. Morally wrong, economically wrong. Please share this video. You folks out there are the Center for Freedom and Prosperity's marketing department. I'm Dan Mitchell. Thanks for watching.